So today we will discuss capital budgeting process. Capital budgeting is a complex process as it involves decision relating to the investment of current funds for the benefit to achieved in future, and the future is always uncertain. However, the following procedure may be adopted in the process of capital budgeting. The first one is investment proposals, second screen proposals, third evaluate various proposals, then fix priorities, then final approval, then implement the proposals, then review performance, and the last one is review performance. So now we will discuss it one by one. So the first one comes, that is identification of investment proposals. So under this you are going to see the capital budgeting is a process begins with the identification, means when it will identify where they need to invest the fund. Second thing, it can be given by any one of the person. It may be given by the top management or by the worker. If the management is ready to invest the fund for a long period of time, they are going to plan it and see the suitable proposal of the capital expenditure planning committee in case of large organization, or it can give it to the concerned with the process of long-term investment decision, those officers who are taking this kind of decision, or they are giving any kind of improvement or any kind of things on that. The second is screening the proposals. So under screening, what they are saying, the expenditure planning committee is seeing the proposal from various or different points of view. They are seeing whether from various angles to ensure that these are accordance with the corporate strategies or selection criteria of the firm, and also do not lead to departmental imbalances. So it won't affect to their own department. And second thing, whether they are relating to the corporate strategies or not, whether the benefit will be taken by the firm because they are investing the funds in the future or not. So they need to see from all the points of view, and after, if the plan fit or if the proposal fit from all the sides, then they can think of implementing that proposal. Next one is evaluation of various proposals. So evaluation of various proposals, the next step in the capital budgeting process to evaluate the profitability of various proposals. How they are going to evaluate the profitability when they are going to invest, or when they are going to give their fund to, or they are going to invest the funds. So there are some of the methods how they are going to calculate the profitability, that is payback period method, rate of return method, net present value method, internal rate of return method. These are some of the methods how they are going to calculate or evaluate the profitability. It should, however, be noted that the various proposals to be evaluated may be classified as independent proposals, contingent or dependent proposals, and mutually exclusive proposals. So what do you mean by independent proposal? These are the proposals who do not compete with one another, and the same may be either accepted or rejected on the basis of minimum return on the investment required. The next one is contingent or dependent proposal. These are the proposals who are depending upon the another proposals, means one or more proposals mean further investment in building of machinery may have to be taken as a result of expansion program. In this you can say that when you want to expand your company, or when you want to increase, you need to first, you have taken the decision that you are going to expand, but before that you need some building land or something so that you can expand. So your decision is depending upon whether you will get the building or you will get the land for the expansion or not. And the last one is mutually exclusive proposal. These are proposals are those which compete with each other, and one of those may have to be selected at a cost of the other. And the next one is fixing priorities. So under fixing priorities, till now whatsoever the management or the officers who are going to take or see the proposals, they've got so many proposals. First they will see whether they are profitable or not. If they are unprofitable or uneconomic proposals, they will directly reject the proposals. But if there is some kind of proposal in which the company can get benefit in future, then they will think it off on that basis, and they are not going to invest the amount on the spot. They require some time. They will see, and they are going to rank the various proposals and to establish the priorities after considering urgency, risk and profitability involved therein. The next one is final approval and preparation of capital expenditure budget. Proposal meeting the evaluation, the other criteria are finally approved to be included in capital expenditure budgeting. However, the proposals involving smaller investment may be decided at a lower levels for expedition section. The capital expenditure budget lays down the amount of estimated expenditure to be incurred on the fixed asset during the capital budget period. The next one is implementing proposals. Preparation of capital expenditure budgeting and the incorporation of particular proposals in the budget does not itself authorize to get ahead with the implementation of project. A request for the authority to spend amount should further be made to the capital expenditure committee, which may be like to review the profitability of the project in the changed circumstances. So when you are investing the capital, then you need to take, or you are starting a new project, you need to request the authority to spend some amount, and you need to provide a given particular time frame and the cost limit, so that it won't be unnecessary delay and cost of runs. Network techniques used in the project management such as PERT, CPM can also be applied to control and monitor the implementation of projects. And the last one is performance review. So in the end, this is last stage, that is performance review. In this you are going to compare, you are going to evaluate. So how much amount you have in real, how much amount you have invested in, and how much amount you have thought of while you were budgeting it. And second thing, how much actual return from the investment you got with the anticipated return. The unfavorable variances, if any, should be looked into and the causes of the same be identified so that the corrective action may be taken in future. So over here we have completed the process of capital budgeting. So these are the kinds of capital budgeting decisions. The overall objective of capital budgeting is to maximize the profitability of a firm or the return on investment. This objective can be achieved either by increase the revenue or by reducing the cost. Thus, capital budgeting decisions can be broadly classified into two categories: those which increase revenue and those which reduce costs. The first category of capital budgeting decisions are expected to increase revenue of the firm through expansion of the production capacity or size of operations by adding a new product line. And the second category increases the earning of the firm by reducing cost and includes decisions relating to the replacement of obstacles, outmoded or worn out assets. In such case, a firm has to decide whether to continue with the same asset or to replace it. Further, in view of investment proposal under consideration, capital budgeting decisions may also be classified as accepted reject decision, mutually exclusive project decision, capital rationing decisions. So, first one, accept reject decision. So, accept and reject decision related to independent projects which do not compete with one another. Such decisions generally take on the basis of minimum return on the investment. All those proposals which yield a return higher than the minimum, then they are going to accept it, and if they don't get the higher return, then they are going to reject those kind of projects. The second one is mutually exclusive project decision. Such decisions relate to the proposal which compete with one another in such a way that the acceptance of one automatically excludes the acceptance of another. Means, if you have started any kind of project and you have said yes, then some other person, or because of your reason, some other person will be ready to invest, or they are ready to compete with you. Thus, one of the proposal is selected at the cost for another. For example, a company may have an option of buying a new machine or the second-hand machine, or taking an old machine or on hire, or selecting a machine out of for more than one brands available in the market. In such case, the company may select one best alternative out of the various options by adopting some suitable technique or method of capital budgeting. Once the alternative is selected, the another are automatically rejected. Means, you want to purchase any kind of machinery and you are having various other things that you can purchase you can purchase a new machinery, or you can purchase second, or you can take on lease. So if you have selected any one of the things or any one of the choice from these, then the other remaining 3 or remaining 2 will be directly rejected. And the last one is capital rationing decision. A firm has several profitable investment proposals but only the limited funds to invest. In such a case, these various investments proposals compete for limited funds, and thus the firm has to ration them. The firm selected the combination of proposals that will yield the greater profitability by ranking them in descending order of their profitability. The capital rationing decisions have been separately discussed in this chapter. So in the next class, we will discuss the method of capital budgeting or evaluation of investment proposals.